risks?
I think if you take a step back from Bullard's comments, we're seeing a significant shift globally. The Bank of Canada, the ECB, obviously even the Bank of England is talking about when to raise interest rates, and the Fed is quite a way down the track. So I think we are seeing that shift, and I think the reasoning is that policy was set for an emergency setting. There are a lot of tail risks. The Fed, remember, the ECB, we're not just managing the main scenario, managing the tail risks. They're all dissipating. European political risks, deflation risks, the risk of a China hard landing, you know, the risk of a commodity collapse and the knock-on effect that has. So I think now is the time to start normalizing policy, and that's the key word. We're not tightening policy to slow the economy, we're normalising policy to a more normal setting.
Yeah, coming off DEFCON 5, absolute emergency levels, which is absolutely essential to have some ammo, isn't it, down the line, something in your toolbox if there is a future crisis. So with this desire globally to normalise policy, what does it mean for your strategy regarding fixed income?
You've got to look what's priced in the markets, and to my mind, what's priced into the front end of bond markets is not enough. There's not enough risk premium there, or to put it another way, why do you own bonds? You own bonds because they're a safe asset and they give you capital gains in the event of bad things happening in the global economy. Well, short-dated bonds don't give you much capital gains if bad things happen in the global economy. So I think that part of the bond market is quite expensive. I think there are other parts of the bond market that are very attractive, particularly credit is more attractive, inflation bonds are attractive, and longer-dated bonds are further down the pecking order, but they give your portfolio some robustness in the event of shocks happening.
But just to challenge, Miles, the normalisation theory, isn't it a little bit far-fetched to say that just because the French election went the way that markets wanted it to, that the problems in Europe are over? Doesn't sound like that to me. There is still a lot of unemployment in some European countries. You've still got a very dangerous election coming up in Italy. Shouldn't we be a little bit wary of this idea that Europe's clear now?
I think in terms of the political risk, the key one was the French election, and obviously Italy is another one. But they presented real tail shocks, systemic shocks to the global economy. You know, if Le Pen was elected, then potentially you're looking, I don't want to say a rerun of a Lehman type scenario, but a tail shock. Yeah. More importantly in Europe is the cyclical upswing we've got. It's not a gangbusters growth type 3%, but this is a strong cyclical economic recovery in Europe, things getting better, unemployment is steadily coming down, credit growth is steadily improving, banks' capital levels are much higher, the whole bank crisis is being dealt with and we're almost there. So why do we have negative interest rates? Why do we have such a large QE program? It's not a case we need rates, ECB rates at 2%, but do we really need them at 0 for the next few years?